Good afternoon, everyone, and welcome to the first episode of Pioneering Pensions. For you who don't know me, my name is Stefan, and I have a passion for pensions. The reason why I put this webinar series together is I met a lot of really interesting people over the years who are changing pension, who are pushing the boundaries, who are the pioneers of pension, and they have come up with very different ideas on how to do things better. I have a passion for pension because it's a very interesting problem to look at. It spans across so many disciplines. It's about investing, it's about pension administration, it's about behavioral science, it's about psychology, it's about member communication, and also the design of how do you sort of build a product for the savings phase and for the spending phase. I thought I wanted to share this with you, all these people and their ideas. So therefore I put this webinar together because I think knowledge is better when you share it and when you learn what other people have learned and improve. The way we're going to do this webinar, I want it to be interactive. So to give you the opportunity to learn more about what's going on. So I will have a conversation in the beginning with our guest, and then half of the webinar, the time is reserved for your questions. So I want you to be really active now. So you have to promise me that, otherwise it will be a very short webinar. But the opportunity there for you to ask your questions. Our guest today is Brnic van Wyk from Qsuper. And I've known Brnic for quite a while. We met, I think, must have been 8 years or so ago. And we've always been discussing how can we make a better pension product for the retirement phase. And what Brnic has worked together with his colleagues on is a retirement solution for Qsuper. And I've seen this solution evolve over the years. I'm really happy to see it's actually evolved into a product that is sold into the market. So I can tell you all the cool stuff that Brnic has done. But before I do that, I want to also let you know that if you want to post a question, you have the chat function, write your question there. If you want to use it on Twitter, you use hashtag Pioneering Pensions, so it kind of finds its way. But with that, Brnic, I can tell you all about the cool stuff you've done and all the your amazing background. But why don't you give us kind of a quick introduction of who you are, but more importantly, why do you have a passion for pension?
Good day, Stefan, and thank you very much for the opportunity and the privilege to participate in your webinar. I think we share many thoughts together. My background, I grew up and worked initially in South Africa. I worked as a pensions and actuary for about 15 years before moving to Australia. And since I've been here for the last decade or so, I've been working in the investments team of a major superannuation fund. And that position has given me the opportunity to travel the world and really meet the world's thought leaders when it comes to pensions. And effectively, what I've discovered is we're all trying to solve the same problem. We've got different jurisdictions and legislations, but fundamentally, we're trying to solve the same problem. And my passion for pension is making sure that all the various components you mentioned, being administration, investments, insurance, and so on, are focused on solving the right problem. And that is my pension. That's my passion for pensions.
Very good, thank you. I was thinking, you started by talking about Australia. What makes Australia different from other countries, for example, UK?
Well, the Australian pension system is a three-pillar system. It has got, the first pillar is a very generous means-tested social security. And that's quite important, which makes it sustainable, much more sustainable than some of the European social security systems, but also supports the savings that people have in the second pillar. And it's probably the second pillar, the compulsory superannuation, as we call it over here, that stands out. And the way I would describe it is it's compulsory participation it is compulsory preservation until age 60, and it's almost indirectly compulsory adequacy, because the minimum rate that employers have to contribute is at the moment already 10% of salaries. That does have a perverse outcome, though, in that because people can never touch their money, when they get to retirement, they always, throughout accumulation, they've been told this is their money, this is how much it's growing, this is how it's invested, and you can only get it when you get to 60. So when people get to 60, they want to take their money, it's mine, I will make the decision, I want options, I want flexibility. So the result is a very immature pensions component or retirement income component. And then the final complicating factor is that the Australian system is a TTE system. So contributions are taxed, investment earnings and accumulation is taxed concessionally, but benefits are tax-free. So when you reach retirement, you can access any and all of your savings without limit in cash, tax-free. And you can invest it tax-free if you take structured withdrawals. But the payment or payout phase is tax-free, which is quite a bit different to most systems.
At least it's much easier for people. You don't have to think about all the tax implications you have in most countries when it comes to drawing your pensions. The organization you work for, Qsuper, if you would sort of compare that with the UK, what kind of organization would you be? Are you like a master trust like Now Pensions, or what would it be the best analogy?
Qsuper is a fairly large organization. I mean, we administer about over 600,000 members, and we manage some 120 billion Aussie dollars, which is probably 65 billion pounds sterling in assets. The fund is what we call a not-for-profit fund. In other words, it's effectively a mutual. So almost like Nest, I would say. That's probably a good example. The main difference, perhaps, is that the Qsuper is the default fund for the Queensland state government. It's got a 100-year history. So until about 5 years ago, the fund was exclusively for people working for the state government. The last 5 years, it has opened up, and effectively any Australian can now join the fund as a member.
Do you see a lot of people joining or leaving the fund, or is it kind of a quite sticky membership?
I wouldn't say it is unique to our fund. It's probably more a function of the Australian system, because the membership of a fund is compulsory when you join a formal employment. People don't really choose. Very few people actually choose funds. In the same way, very few DC savers choose investment strategies. So the churn or turnaround between funds is relatively low, in fact.
Okay, thank you. I was thinking also, when you developed this product in your sort of portfolio at what Qsuper offers, what was sort of the hole that your lifetime pensions product was filling? So what were you trying to solve?
Well, the only real option we have at retirement and until date, and that's the reality for most Australian, almost all Australian funds, is what is a drawdown account. So when people reach retirement, they can roll their money into what we call our retirement income account. And from there, you can take structured withdrawals. And that's the standard DC decumulation strategy. The Australian system, to get it in the tax-free environment in retirement, has a set of age-based minimum drawdown rates. So at age 65, for example, it is 5%, at age 75 at 6%, and it increases to about 14% by age 95. But that is all. And what that means is that people see it almost as a recommendation from the government, as the rate at which they should withdraw their money. The outcome, though, is firstly a very volatile retirement income, because money generally remains invested in market-related instruments. And it's also an income that increases almost exponentially at very advanced ages. And people do not have the confidence to spend more than the minimum. And most people actually just draw the minimum. And that's probably how I would describe the main gap that we're trying to fill, is that just helping people convert their capital to income, guiding people as to how much they could draw safely without the fear of running out. So if you could imagine the retirement phase as a spectrum from, on the one end, a complete money-based DC drawdown account where you make investment choice, you choose your drawdown rate. And on the other extreme is the fully insured insurance company lifetime or even deferred lifetime annuity. What we've done is we've launched a product sort of just a little bit more than a traditional drawdown account. And the intention there is for it not to be better than or contrasted or be selected rather than any of the other options, but rather to complement it. So we present it as what we would call layering income. You would provide perhaps income for life's necessities through a lifetime income and use the balance of your money in a drawdown account for discretionary spending or for emergencies.
Thank you. I was thinking, for people, we had sort of a link going out. You can learn a bit more about the Qsuper product. But if you would do sort of a quick elevator pitch, what's you're really offering in this sort of retirement product? And think of it like you're an elevator in a four-store house rather than a skyscraper.
Well, I put it very simply. This product offers people the ability and the confidence to spend as much as possible of the retirement savings, knowing that they will never run out of money.
Simple and fair. Sounds like DB. One thing which, more technical people might wonder about. So you have a way of pooling individual longevity, but you're not an insurance company. How do you get that sort of problem solved or addressed? Because this, I think, can be quite useful for the UK industry in terms of thinking about how to deal with a lifelong income.
Stefan, we did not set out to solve longevity risk per se. As I said, we set out to help people maximize their income. But in order to do that, in order to provide them a product that maximizes their income, we actually had to solve for longevity risk behind the scenes. And that longevity risk that we're solving for is not what the UK sends around between reinsurers on insurance company balance sheets. We're not talking about systemic longevity risk. We are talking about idiosyncratic longevity risk. The fact that every individual is uncertain about when they are going to die or how long their money needs to last. So individuals are not worried about becoming 100 years old and running out of money because they get very old. They're concerned about running out of money because they're uncertain how long they're going to live. And that idiosyncratic longevity risk is solved through pooling. And I would almost say, to your point about technicalities, that is actuarial 101. Idiosyncratic longevity risk is solved through pooling. And we have an experience-based pool. So the experience in the pool is used to adjust pensions on a periodic basis. And I would almost go one step further now as well to say the challenge is then going to be, but what about systemic longevity risk? I would suggest to you that that happens over decades and happens incrementally over shorter periods of time. And because we put the experience that the pool has into the pensions in payment, we can effectively, the pool wears its own systemic longevity risk, not instantaneously, because systemic changes don't happen instantaneously. They happen very gradually over time, and we can put that into the pool's experience over time. And this experience-based pool means that we have no reserving We have no capital requirements. We have no funny actuarial subjectivity or black box as to what the change in pensions are going to be every year, like those traditional with-profits annuities. It's very transparent, and people can almost see as the experience in a year develops what their pension adjustments are going to be in the year following.
So basically what you're saying is, when it's experience-based, whatever the balance is at the end of the year, that's redistributed among the members according to some rules, and that sort of settles it, which is a nice way of doing it, because you don't have to do some really difficult calculation or have assumptions about future returns.
Yes, so we almost can't be wrong, right? We have an investment return assumption in the annuity and a very light mortality rate. So every year, the deviation from that experience is used to adjust pensions in payment, and that ensures that the pool remains solvent over time. And two words that you will not find in any of our member communication or any of our disclosure documentation or on our website is the word longevity doesn't exist there, and the word annuity doesn't exist there.
That's a good step forward, because with annuities, everybody likes what it is, but everybody hates the name. So it's a good way to sort of avoid it. I was wondering, how did you get the inspiration to do this design?
The inspiration to do this product, Stefan?
Yeah. I mean, what sort of, when you were thinking about it in the early days, we were talking, and you had, I think we had quite a technical discussion in the beginning, and then I see you moved more and more to more pragmatic, kind of explainable, straightforward, simple solution. What made you move that way?
Well, I don't think we are going to find any innovation that 160 years of actuarial science hasn't already discovered or researched or published to death, right? So we really went, and as I said, my employer gave us a great opportunity. We literally went around the world and looked for the smartest people we could find and got ideas from them and copied them. And we used all the useful bits that we could find that was applicable to our problem. So probably I want to give credit to UBC, which is the University of British Columbia in Canada, where they have a product like this that has been operating for over 50 years. Sustainably, it is available to the faculty of the university. They apply the logic and the rules, and through thick and thin, it has worked. Right. So I think there's the basis of what we used. We copied them, and they're aware of it. We give them credit for that. But then also, I'll give you an example. So somebody that we went and saw was Don Ezra, and Don came up with this idea that said, he used the word satisficing. And he said, whenever you need to design something new or think of a product, you have to use the principle of satisficing. And he explained it by contrasting it with the word optimization. Whereas he said, optimization, you have to be right. You have to get it perfect. And that's a very, very hard and a very high bar to achieve. He said, on the other hand, if you have the principle of satisficing, you build something that is good enough or something that is not wrong. And that allows you to make progress. So those were, we took that back with us, Ben and I, my colleague, and we gave our project team two principles. And that was this product has to be simple and it's got to be compelling. And if you can't do that, then don't bother.
That's a good assignment to get if you're like a product developer. Because I think sometimes people expect you to do very complicated stuff just because you're supposed to do that, rather than doing what's simple and straightforward. There was one thing that I remember when we talked, there was one nut you find very difficult to crack, and eventually you were able to do that. How to make this sellable? I remember you talked about interviewing people and figuring out the importance of having a sort of money back guarantee in it. Can you tell us a little bit about the conversation you had there? Because I thought it was very insightful to me. So please share it with the rest.
Yeah, thanks, Stefan. I mean, I hope I've been clear that we did not set out to solve every problem. But the one problem, you're right, is making it sellable. And in a technical forum, I'd be comfortable to call it a type of annuity, right? But when you, as you pointed out, you can never call it an annuity for people, because people see annuities as they lose their money. So we did heaps of research. We called people, we had interviews with people. And there was this one lady in particular. We asked people to rank the different components of retirement income, whether it's inflation risk or higher income or volatility or bequest or longevity, right? And we'd give them two and we'd say we'll rank them. And there was this one lady that ranked bequest was dead last. And we asked her about that, and she said she doesn't have to leave any money to her children. They are adults and they're very successful and self-sufficient. So she is comfortable to spend all her retirement savings on herself. She doesn't need to use her retirement savings for a bequest. And we then explained to her how this product works, and if she had to pass away, then the money would remain in the pool. And she was completely against it. But she said that was just not acceptable. And we said, but you just said bequest was last on the list. We don't understand why now suddenly you've changed your mind. And she said, no, it's not about a bequest. I don't mind not getting the money, but I do mind if you get it. That's not fair. So it actually wasn't a matter of wanting to leave money for their children. It was a question of fairness. They wanted to get a fair return for an investment that they're making. So to make this product sellable, we had to be able to tell people you always get your money back. And that's probably the only economically inefficient feature of the product, is that we provide a nominal return of capital less payments to date. So if somebody had to die early in the after purchasing the pension, there's a return of nominal capital, and that's tested very positively, and it was an absolute requirement of feature of the product in order to make it sellable.
So economically inefficient, but emotionally efficient. Is that how you would paraphrase it? I was thinking about one thing here, because we also had this conversation about how do people use your product. And I remember you said when you design the product, you target a certain segment. And then when you actually saw what people were doing, you were a bit surprised. Can you tell me a bit about your design process and how people actually end up using the product?
Yeah, it goes back to what I said at the start, what the Australian system works. Because there's a very generous social security, we were of the view that retirees with very little savings would probably get the full, what we call the age pension in full. So probably don't need any longevity product or retirement income product. The retirees with significant savings, due to the means testing, get zero social security benefits, but probably have enough money to self-insure, right, and draw down, so, and make investments. And our target market was probably that sort of middle size of the savings. And when we started, when we launched the product and people started buying it, we were completely surprised by what we saw. Right? The very first day, a lady bought a lifetime pension with $240,000, and it was all of her savings. And we called her and said, just make sure you understand the features and all these things. But on the same day, there was another gentleman that used 400,000 of his 1.2 million to buy a joint life pension as well. And he had the same surname and the same address as this lady. So these are things we couldn't see on admin records, but we could see that this household effectively put roughly a third of their household savings into a joint lifetime annuity. We had a lady with barely $100,000 who used half of it to purchase a lifetime pension. And she explained to us that she knew she had modest savings and knew that it wasn't a lot, that she would be age pension dependent for the rest of her life, but she felt that this little bit of extra gave her just that extra coffee at the club on a Friday or Christmas presents for the grandkids. Just a little bit more than Social Security gave her comfort. There was a couple that each put in $1.5 million, and they basically said they have no children, they've got adequate savings, and they just want to spend as much as possible, knowing that they'll never run out of money. So it was quite an eye-opener to see that what we as technocrats or actuaries or designers thought the product was used for, and the way the public perceived it, on paper for us, it looks like irrational decisions. But when we dug into each individual person's circumstances, these individuals made very, very rational decisions given their own circumstances, and often things that we couldn't see. We couldn't see other household assets or other household circumstances. And maybe a final example is a gentleman who bought a lifetime pension with part of his savings. He had a substantial amount of savings. And he said this was for discretionary spending for his wife. Remember I said earlier, normally an annuity is your sort of essential spending. He bought it as discretionary spending for his wife, saying that now he knows she can't burn through the capital. So she gets this income and she can spend it on whatever she wants, and he knows it'll never run out. So it's interesting. Some people, also expressed concern about having to make significant financial decisions later in life. We've had an unexpected number of older people who are single buying it and expressing sort of maximizing income, because at old ages annuity rates are actually quite good, saying that they can't get these returns in the market anyway. But irrespective of whatever the people said, the common theme coming through from almost all of them was a peace of mind theme. One where they were saying they know now that they have this, they won't run out of money. They know they can spend the money, and they have that confidence. And that's probably the foundation of what we built.
So basically a bit of a carpe diem in it. I don't have to worry about it. It's taken care of, and I can go on and do what I like. How many customers have you to date? How many people have bought this product?
So we launched in March this year, and we're just over 300 customers now, with a total of, I would say about $65 million. So let's say 40 million pounds. It's still very early days. We did not publicize this. We did not market this. The scheme that I work for is busy going through a significant merger. So due to all of that noise, we were asked not to distract anything. So this is really just organic, almost word of mouth. Sort of people that have come forward. We did send letters and familiarize this with our existing retirees, because we felt that was a good way to get up the curve and across the age spectrum in a pool quite quickly, rather than future retirees, because the behavioral challenge of making a now or never, all or nothing sort of decision at retirement is pretty severe. So people who have already experienced retirement, and particularly those for the last decade who now probably have more money than what they had when they retired, those have been people that have taken it up.
Okay. Well, I think we should turn to the audience now to see a couple of questions. I have one from Henry Tapper, and he says, maybe one for Stefan and Brnic. Other than the nominal return of capitalist payments made, is there anything in your solution that doesn't look like a CDC plan, collective DC plan, established for spending DC pots? What do you think, Brnic? Do you know the discussion around collective DC in the UK, for example?
Yes, so I would classify collective DC as a defined ambition. In my language, and the way I understand a CDC is it is still pretty much, it's still a DB fund, right? And you just do not have that absolute guarantee or covenant from the employer, or the requirement for the employer to make good shortfalls. But in a CDC, you will have an accrual rate, you'll have a target return, and if you don't make that return, you can reduce your accrual. This is a little different. This is only from the point of retirement onwards. So take our scheme, for example, we have a large closed defined benefit section, and that defined benefit section of our fund is actually defined benefit lump sums. They're not DB pensions. So we have members getting to the point of retirement that then get told based on a formula, this is your sum of money. And we have others that are investing in DC pots. But for both of those, they need to make a sort of a conversion of capital to income at a point in retirement, rather than a CDC, which accrues over time. And probably for me, in running this, the big distinction is CDC has the risk of that intergenerational risk transfer and an intergenerational cross subsidy, because as things get worse, people now experience something that happened previously. Whereas in our structure, what we do in this product is, because we periodically every year adjust pensions in payment, anybody entering the pool enters at a 100% funding level, and the pool is always at a 100% solvent level effectively over time, which means that there's no transfer of wealth or intergenerational cross subsidies between existing and future participants.
My take on it would be, where you started, Brnic, is you started in DC and took a step into how can you pool longevity to get a lifelong income, while CDC started at DB and trying to say, can we use this technology to deliver similar outputs? My gut feeling is that your approach seems easier to selling and get across, because it is not it's a much easier buy for anyone, and you can do it as an individual as well.
But Stefan, that probably links to the spectrum I described earlier, whereas the drawdown account, we just built the one right next to it. So if your departure point, like the UK, is the defined benefit or compulsory annuitization, then CDC is the sort of the first step away from that. So it doesn't make them wrong. It just.
But I would say the UK took a huge step from having DB, jumped straight into the DC camp, and now they're trying to figure out how can we get a good solution. So I think your solution is quite relevant for the UK market, because a lot of the money in Master Trust are exactly in the position as Qsuper. We have a question for David Bird as well. And he basically says, you talk about customers buying the product. How do they do with advice or guidance? And how does that work? And is there any form of default path for members? So the idea here in the UK, there's a lot of discussion about people are not advised. There's an advice gap. And what should you do at retirement? And there's discussion about creating a sort of default that you've been sort of in auto enrollment, and now you're going to go in auto decumulation some way. So where do you stand in this sort of aspect in the Australian market?
Oh, the danger is to pretend that I represent the Australian market.
Your view then.
What we've observed is the overall majority of people who have purchased our product have been self-directed. So they have not been advised. We have developed significant collateral, websites, training, calculators, disclosure materials, seminars. We've done heaps of information where people can almost self-guide themselves. The formality of financial advice is unfortunately, and I think the UK is similar, dominated by compliance. So a financial advisor needs a product to be certified by a ratings agency, right? It needs 5 crowns or stars or arrows or something. And when it has this certification, that is a compliance tick for the advisor in order to recommend the product. Now, in the Australian market, there is no certification or ranking or rating for retirement products. So we had to build advisor training materials, CPD, all those kind of things, in order to allow advisors to actually recommend the product. So the advice industry is hamstrung by the regulation governing it, which is unfortunately very compliance-based. So we are seeing advisors come to the table. There is part of our legislation to encourage the take-up and development of products that have a longevity component in it. There's a concessional treatment for social security benefits, but that effectively requires almost a bit of an optimization of personal finances. So you've got to go and see a financial advisor, somebody who can look at your tax and all these kind of things. And we're only now sort of 5 or 6 months in, starting to see applications from people that come through the advisor channels. So it's a slow burn, but I don't think it is necessary to go either way with that. Australia is very definitely not moving towards a default. There's not any support from government, industry, or any funds in that space. There's way too much concern around unique circumstances and customized answers. But there is sort of a work underway for the government to introduce the retirement covenant in legislation that asks trustees to have a retirement strategy. And that retirement strategy can be, effectively has nudges. So it means a certain type of product could be put in front of certain classes of members. And to your point earlier, in my language, that is almost like an anchor bias. It's not wrong, but at least it gives people a starting point from where to start considering their options.
Thank you, Brnic. We have a question from Manuel Garcia, and he says, how does this product complement the other products in Qsupers offering? How much of the savings are devoted or advised to devote to this product in general? I think you partly touched upon this, but I mean, you have this drawdown and you have this sort of lifetime, and those are the 2 products you can choose among when you retire. Is that correct?
You can now, yes, but historically you could not. So, I mean, of our, let's say, 120 billion Aussie dollars, about 30 billion is in the retirement phase already, and we have 40 million in this product. So, I mean, we're only just starting out. We have people that have purchased the product that have money in other super funds, that have left some money there in drawdown accounts and brought only money to Qsuper only to buy this product. So for us as a member, this member only has this product. For those retirees that already were with Qsuper. The average of those 300 odd members that purchased the product, on average, they used about 50% of their pot. So if they had $1 million, it would be 500,000. If it was 200,000, they would have used 100. And that's maybe no accident, because when you go to our website and you go to the calculator, the landing page is 50% allocation. It is not a default. In fact, when you fill in the application form, you actually can't say 50. You have to put in a dollar amount. You have to put in an amount you want to use. But the spread is very wide. People use very little of their money or very lot, but on average, as we all know what averages are, it's roughly 50%.
And if you don't know what to do, half in one and half in the other is probably a good bet, right?
1/n. Yeah.
Exactly. We have a question from Theo Kocken, and he says he do understand well that the way of dividing the money is purely based on longevity results and not based on expected returns that change into a CDC scheme with people fighting over the discount rates, ? Do you get the question, or do you need some elaboration?
Yeah. Let me perhaps just say our product has an investment return assumption. The annuity rate assumes a 5% return. So if returns are more than 5%, we can increase pensions. If returns are less than 5%, we reduce pensions. But our assets are not invested in traditional insurance company annuity pools. Our assets are invested in our balanced option. That is a multi-asset class pool, sort of call it a 70-30 option. It's historically been the default option. It's got a very long history. It's completely transparent. It's got high expected returns over time, but probably much more volatile than a conservative option. And that high expected return gives you a higher expected income. So with the 5% benchmark, we would argue that is a slightly conservative return assumption, which creates an expectation of increases over time. The mortality assumption, on the other hand, is very light, which I would say is a much more realistic assumption, so that your expectation is very small adjustments as a result of deviations from that experience. And perhaps a final comment on that, in just how this product operates. The UBC in Canada have two options. They've got a 4% option and a 7% option. So at retirement, people can choose. If they choose the 7% option, the starting income is much higher, but the expected increases over time is lower. So that almost, in technical terms, probably mirrors a nominal annuity, whereas the 4% rate has an expectation of increases, which probably mirrors a sort of a real annuity. And ironically, they find most people put half in the one and half in the other, right?
I think that's universal. The 1/n beats everything. I was thinking with this as well, you pick that investment strategy because then people say it's little change because I have that investment strategy while saving. Now in retirement, I have more or less the same investment strategy. So there's nothing new, nothing scary. Was that a thought, or did you have any other thoughts behind it?
No, that is the thought. I mean, another one of the world's great thinkers in this space, Moshe Milevsky, one of the things that he left with us was, if you pool money, you've got to create transparency. People want to know who they share with, and people want to know what's happening in the pool. And the investment return and the investment strategy dominates the experience that the pool will have. It far dominates the mortality experience. So the balanced option creates a very transparent investment strategy. There's significant disclosures around this option. It is daily unitized. So members can actually go on the website and see the daily returns. And then obviously as the return for a year accumulates, they can start creating a very good expectation of what pension adjustments are going to be in the year following that. For us as well, in Australia, we have the ability to invest quite extensively in private assets. We've got significant infrastructure, real estate, private equity exposure. That means that this pool of ours is very well diversified across liquidity risks, equity risks, fixed interest risks. So it gives us a much less volatile growth pool than what, say, a 60-40 equities bond portfolio traditionally would do. So in order to give those access to those returns to retirees is also quite valuable. Maybe something we actually haven't said, which should be very obvious, is, and we are very clear about this in our communication, is income is volatile. So income would be going up and down as markets move. But remember, in Australia, with people investing their money in this same balanced option and drawing the minimum, they experience this income volatility already. So we actually we're not insuring or underwriting any investment guarantees. We could probably over time put protections and volatility management strategies over it, but for now, the simplicity, people understand this product, this investment option, they've been invested it already. So yeah, it's very important part of the design. It also means we didn't have to seed any capital, right? Because then you got the first dollar and you can only buy so many things with $1. So we were able to, in building this product, access liquidity in a very large pool as well.
Yeah. And I think managing expectation is the key to anything in pensions, because that's where things goes wrong. We learned that from Chile, we learned that from Holland as well. There's a question from Adrian Balding. Does Qsuper offer the product with and without the money back guarantee? And if so, how are sales splitting between those who want the money back guarantee and those who want the higher, presumably higher starting pension income?
Short answer, no. The money back guarantee is a product feature. It is not an option. It is actually the only part of the product that we insure. So we take out a traditional vanilla whole of life insurance policy with a registered insurance company, and we pay an insurance premium. So the sum insured for every individual decreases over time and effectively goes to zero by the time all the capital is paid back. What I would say though is Challenger, which is an insurance company here in Australia, have actually launched a market-linked annuity, something roughly similar to this, on Monday this week. And they actually offer the option to take the death benefit or not. So we did it in our experience-based pool. We insured it in order to protect the pool from that market risk relative to the nominal guarantee, particularly early on.
Thank you. And we have a question for Qsupers van Wyk. Do you have experience of how to convince self-employed to buy pension products? Do you have a separate approach or design of the product for this special group? Question mark.
Short answer, no. There's not a specific strategy for self-employed. I think self-employed is a problem much broader than this product. So the self-employed are not caught up in the compulsory nature of the Australian system. The compulsory nature of the system only applies to those in the formal employment sector. So, but that does not stop the self-employed from purchasing the product. There are technicalities in law in terms of having saved money in the system. So we cannot offer this product to non-super money. So you've got to get money into the system first, and then, yeah, you can purchase the product. But there are ways for self-employed. People sell their businesses when they get to retirement, and there's once-off concessions for getting large sums of money into the system. And then that's effectively a channel that people can use. But we have not targeted self-employed specifically, no. Because remember also, the problem with self-employed is probably more the accumulation component, not the decumulation. And this product does not address the accumulation. It assumes you're already coming to us with your money accumulated.
Thank you, Brnic. There's a question from Sam, and she says, "Hi, Brnic, what do you mean by light mortality overlay?"
Sorry, my apologies, maybe my accent or ethnic background. What I meant was the mortality assumption in our annuity pricing, in the pricing of our starting rates, is a very light mortality rate. In other words, we don't use population mortalities. We take the population mortality table and apply every conceivable possible mortality improvement we can find to make it as light as possible. In other words, only people we'd expect that are healthy and expect to live long are those that take out this product, because it's not underwritten. So we don't have an impaired, for example, option. And what that does is it means that the mortality credit that emerges in the pool is actually fairly marginal. But it also means that if nobody dies, like what happened in the first financial year so far, we have to make a negative adjustment. But that negative adjustment is actually quite small relative to the investment experience. So, example, our first pension adjustment in July this year was 7.5%. So the investment return was 7.9. This is over and above the 5 benchmark. So this was the adjustment we declared. The investment component was 7.9%. The mortality component was minus 0.4% because nobody died. So it's interesting. If somebody had to have died, we would have had a very large positive mortality adjustment.
Because you have such a small pool, right?
Yeah, it's still starting out. Yeah, where we expect we probably need about 500 plus lives for the mortality experience to start stabilizing.
Brnic, I think we're basically running out of time now, so I will not take any more questions from the chat, but I have a final question that you can ask someone. And since Don Ezra, which you mentioned, is our next guest in this Pioneering Pension, I would like to ask you, what question would you like us to ask Don Ezra next time?
Oh, well, I hope I've been clear that we did not set out to solve all the problems, and we are not presenting our approach as the silver bullets to solving the world's retirement problems. We did this on the basis of satisficing, and my question to Don would be, on the basis of satisficing the provision of retirement income to the masses, what areas should the industry focus on first? What are the big rocks that should go in the jar first? And what are the items that we can leave for later?
Thank you, Brnic. That was a really good question. And let's see what Don says about it next time, which is on November 4th at 2 p.m. UK time. Brnic, I thank you very much for coming here and enlightening us about the design in your scheme. I find it really exciting because you actually point at a good solution. It should be intuitive, easy, and satisfying. Solve the problem, not optimizing beyond understanding of normal people, because trust and expectations is really important here. People need to expect what they want to get, and their outcome shouldn't be too far away from their expectations. I would also like to thank everyone here in the audience for participating, and I'm really looking forward to seeing all of you and your friends next time when we meet with Don Ezra. So until then, take care and see you soon. Bye-bye.